On the previous video, we learned about the history of candlesticks. We learned about how candlesticks came to be formed. We learned about Monehisa Homna, who's the godfather of candlesticks. We learned about how the West came to learn about um, candlestick patterns, candlestick charts, I mean, rather. And in the late 1980s, when there was cross-pollination between banks, we also learned about the candlestick anatomy, where we learned about the open, close, the highs and the lows, and what a real body is. We learned about the wicks. And right now on this video, I want us to learn more about the candlestick patterns, where we'll be going in depth, talking about individual candlestick patterns, of which can give a very good entry signals when applied into your daily trading activities. So if this is something that you would like to see, make sure that you are subscribed and like this video so that you can see more of this video. This is the second episode. If you haven't seen the last video, I'll put it up there so that maybe you can start with that one so that we can be on the same flow. And if you are coming back on the second video, thank you. Make sure you like this video so other people can be suggested as well. And without further ado, let's jump into the computer right now. The candlestick patterns. So candlesticks are one of the most powerful concepts, trading concepts. They are simple, easy to identify, and very powerful trading setups. This trading system works, but be prepared to lose some trades. Losing is part of this game. If you're looking for a 100% winning system, I highly recommend you stop trading and go look for another business. Candlesticks are the language of the market. Imagine you are living in a foreign country and you don't even speak the language. How could you live if you can't even say a word? It's tough, right? The same thing when it comes to trading. If you know how to read the candlestick patterns the right way, you will be able to understand what these patterns tell you about the market dynamics and the trader's behavior. This skill will help you better enter and exit the market in the right time. So we are going to focus on the anatomy of the pattern and the psychology behind its formation. And the first candlestick pattern that we are going to look at is named the Engulfing Bar candlestick pattern. And as it states in the title, it is formed when it's fully engulfed by the previous candle. The engulfing bar can engulf more than one previous candlestick, but to be considered an engulfing bar, at least one candlestick must be fully consumed. And there are two types of engulfing bars. The first one is bearish engulfing, which is one of the most important candlestick patterns. This candlestick pattern consists of two bodies. The first body is smaller than the second one, and in other words, the second body engulfs the previous one. So we can look at this one right here. We can see this smaller body, and this one has a bigger body. So this bigger body is engulfing the previous one, and it is bearish. This is a bearish candlestick, of which we covered what a bearish and a bullish candlesticks in the previous video. So if you haven't watched that video, kindly I'll put it up there, or maybe at the end of the video I'll link it so that you can be able to know what a candlestick is. So you can see where the opening price and the closing price are. And yes, in case of a bearish engulfing bar, this pattern tells us that the sellers are in control of the market. When this pattern occurs at the end of an uptrend, this indicates that buyers are engulfed by sellers, which signals a trend reversal. So if you look at this chart right here, we were comfortably moving in an uptrend, but when this bearish engulfing bar happened at the top of an uptrend, you can see it changed the rhythm of the flow. So now the sellers became more in control of the market. So that is how the bearish engulfing bar is powerful. But remember, we cannot just use the bearish engulfing bar on its own. We have to look at other factors of confluence so that we can take such a trade. Yeah, but this is one way of which you can identify a trend reversal using a bearish engulfing bar. So the next type of engulfing bar is the bullish engulfing bar, which consists of two candlesticks. The first one is the small body and the second one is the engulfing candle. So we have this example right here when we can see this smaller body, and now we have the engulfing bar, which happens to be bullish on this time of the period. So we can see the opening price right here, the closing price right here, and this whole body fully engulfs the previous one, so making this a bullish engulfing bar. So the bullish engulfing bar pattern tells us that the market is no longer under control of sellers and buyers will take control of the market. When a bullish engulfing candle forms in context of an uptrend, it indicates a constitutional signal, a continuation signal, pardon, when a bullish engulfing candle forms at the end of a downtrend. So we have this example right here. We can see we were clearly in a downtrend right here, but now we saw this bullish engulfing bar, which shows that now the sellers are no longer in control and now the buyers have taken over. And now you can see from that we were able to push the market upwards. So that is one way we can look at these engulfing bars. So we have the bullish engulfing bar and the bearish engulfing bar. So we have the second type of candlestick pattern, which is known as the Doji candlestick pattern. And when this candlestick forms, it tells us that the market opens and closes at the same price, which means that there is equity and indecision between buyers and sellers. There is no one in control in the market. So we need to, this is the key points: equality and indecision. So there's no one who's really in control. But we can see on this example that we have right here. So we have the highest price, we have the lowest price, we have the opening and the closing price, which are about the same price, meaning that there is equality and indecision between buyers and sellers. When this pattern occurs in an uptrend or a downtrend, it indicates that the market is likely to reverse. So that is something to take note of. So we can see this chart shows how the market changed direction after the formation of a candlestick. So we were trending upside, we are trending upwards, but after the formation of this doji candlestick came to prove that there is a indecision or equality of buyers and sellers, and the buyers could no longer take control of whatever was happening in the market, so the sellers were able to overcome. So this doji candlestick came in and brought that indecision and imbalance, into the market. So we have the second type of, or the first type, of a doji stick, doji candlestick pattern, of which one is known as the dragonfly pattern. So the dragonfly doji is a bullish candlestick pattern that is formed when the high and close are the same or about the same price. What characterizes the dragonfly doji is the long lower tail that shows the resistance of buyers and their attempt to push the market up. So we have this example right over here where we can see it's a bullish candlestick, and we have the closing price and the opening price right around the same area right here. We can see there's no much, and it is characterized by a long tail, of which we can call it as a wick or shadow, as we discussed in the previous video. So this shows us a perfect dragonfly. The longer lower tail suggests that the forces of supply and demand are nearing a balance, and that the direction of the trend may be nearing a major turning point. So we can see an example here. So we were originally in a downtrend, but as we can see here, a dragonfly doji formed, which means that now the buyers were coming into the market and were able to push up the market up, and the sellers could not progress on whatever they were on, the trend that they were on. So the buyers overcame, and now we have the market shift now moving, or a reversal rather. Now we have an uptrend after that dragonfly doji happened to be in the charts. So now we have the second type of a doji candlestick, which is a gravestone doji. So the gravestone doji is the bearish version of the dragonfly, where the open and close are about the same price. What differentiates a gravestone doji from dragonfly doji is the long upper tail, or the long upper shadow or wick. The formation of the long upper tail is an indication that the market is testing a powerful supply or resistant area. We have a very good example right here of a bearish candlestick, a gravestone doji, which is the bearish version of the dragonfly doji. You can see that the closing price and the opening price are almost at the same price, and it is characterized by the long wick or shadow. So we have this example right over here. So we can see this example, we were definitely in an uptrend, but when this doji candlestick formed, um, meaning that now the buyers have been overcome by the sellers, and now the sellers are in control of the market. Thus you can see all these sell off, or rather creating a downtrend. So that reversed the main trend that was going on. So we have a morning candlestick pattern. So this is the third candlestick that we are going to look for, and I have a quick one. In all these patterns that I'm trying to teach you guys, you need other factors of confluence so that we can use them together with this candlestick pattern. So don't just jump straight into the charts and start looking for these formations and start just trading off them. There are other factors of confluence that we'll deal with in other videos, so be on the lookout for that. Make sure you subscribe to this channel, by the way. If you're loving this content, give us a thumbs up, and make sure you subscribe to this channel so that you can get notified every time we drop a video. So back again, we're going to the third candlestick pattern, which is the morning candlestick pattern. I mean the morning star. Oh, I forgot to write that in my PowerPoint. So yeah, I've just realized that. So the morning star pattern is considered as a bullish reversal pattern. It often occurs at the bottom of a downtrend, and it consists of three sticks. The first candlestick is bearish, which indicates that sellers are still in control of the market. The second candlestick is a smaller one, which represents the sellers are in control, but they don't push the markets lower, and this candle can be bullish or bearish, so it doesn't really matter on the second candlestick. Of which one is this? This is the second candlestick, so it doesn't matter if it is bullish or bearish. Now we have the third candlestick, which is a bullish candlestick that is gapped up upon the open and close of the midpoint of the body of the first. What am I saying? The third candle is a bullish candlestick that gapped up on the open and closed above the midpoint of the body of the first day. All right, this candlestick holds a significant trend reversal signal. So this body has to have gapped this small bearish candle or bullish candle, and probably this bearish candle. It doesn't really matter if up paces, but at least one of these this one or this one. It has to be exactly bigger, so that probably you might confuse it, because when you look at this, it looks like an engulfing bar, but you can see where the open was. Here is the open, here is the close, this is the lower wick, this is the upper wick. So you can see where it opened is almost at where this one closed. So it's not really an engulfing bar, because it's not engulfing the entire the previous candlestick. So yeah, so the morning star pattern shows us how buyers took control of the market from sellers when this pattern occurs at the bottom of the downtrend near a support level. So in a chart, we'll be able to see, let's say this is a chart right here. So that's a chart right there, and we are moving up. So this is usually the support, this is usually the resistance. So when this pattern occurs near this support level right here, it is interpreted as a powerful trend reversal signal. So when this trend uh, comes down here, it's more likely that we are going to keep on going up. All right, I hope that one is clear, and we can go to the next one. We have this example right here where we can see we were definitely in a downtrend. This is probably where the support is. This is probably where the resistance is. And we can see when we definitely came down here, we have this. That's why I told you it has to be at least bigger than one of them, because you can see this uh, bearish candlestick is bigger, but it doesn't mean that this reversal is not sustainable or worth to be called a morning star. So we can definitely see after this morning star candlestick pattern formed, we were able to change back to an uptrend. But as I'll keep on saying again and again, we have to, this is only one candlestick pattern. We can't just go on to the markets and just use that as the only way we are using to identify or looking for an entry in the market. We have to factor in other factors of confluence, of which we'll talk about more of them in the subsequent videos. So we have the fourth, and which is the last candlestick pattern I'll be talking about today. I don't want to make this video too long. So we have the evening star candlestick pattern. So the evening star candlestick pattern is considered as a bearish reversal system pattern that is usually occurs at the top of an uptrend. So it's just the opposite of a morning star. The pattern consists of three candlesticks. The first candlestick is a bullish candle. The second candle is a small candlestick. It can be either be bullish or bearish. You remember we had the same on the morning star, and it can either be bullish or bearish, or any other candlestick. It can be a doji. The third candle is a large bearish candle. In general, the evening star pattern is a bearish version of a morning star. And we have a very good example right here, when you can see we were generally moving up, but when this candlestick formed, is a probability that we are going to have a sell-off, or the trend is going to turn bearish. So we have a very good example right here. So we can see we were definitely in an uptrend, and after this evening star pattern formed, we changed. And whenever, especially it happens in a resistance, in an area of resistance, so these are a resistance, and probably the support is down here. We can see when we got to this position right here, it gives a very good entry position to short the market. So again, don't go just using the evening star or the morning star. We need to use other factors of confluence so that we can have a good entry position when trying to use the evening star candlestick pattern.